In your money this week, we had some economic reports that Andrew and I are going to talk about. We had a good jobs report, a good CPI report. Stocks, looking at the S&P, were down a bit, maybe a bit more than 1%. Same with small cap stocks in the US, and international shares up close to 1%. And we saw some movement in the 10-year yield down to 4.09. Andrew, I know you want to talk eventually about some winners and losers and things that you're seeing in the stock market. Then we're also going to dive into where we are in the economic cycle because you and I think, talk about this a fair amount. I think we have slightly different perspectives on it, and it'd be good to kind of hash it out. And also, I think helpful for people to have a baseline of expectations as to where we are as they're making decisions with the economy, so we can kind of look at it from a couple different perspectives. But let's start with the jobs report. It was strong, very strong. What did you see when you looked at it?
Yeah, I was pretty floored by it to see 130,000 jobs created. I think for me, the thing that I'm struggling with, and I think the reason that the market may be discounting the jobs report is there's just so much anecdotal evidence around that the employment picture is not all that strong. When you look at initial jobless claims, they're relatively stable, but they're relatively elevated compared to where they were a year ago. We track layoffs specifically in the tech sector here at Narwhal. So layoffs.fyi is a resource you can go to. You can see how many companies are laying employees off and what the numbers of those are. In January, we had 10 times as many layoffs in the tech sector as we did a year ago. So I continue to really struggle with that, especially when I think of longer term trends where we have government employment has declined by almost 11% since it peaked out in October of 2024. That's a huge number of people. And yet we're sitting here looking at an unemployment rate of 4.3. So to see essentially an improving labor market, according to this data, that's hard for me to stomach and digest and really take it at full value. And I think the market kind of viewed it the same way.
Yeah, the market essentially was flat after that report came out, and it is by all measurements a blowout report compared to consensus. Although then you start to factor in the things that you were thinking of. The other thing that came to mind to me as to maybe why the market didn't react more favorably is because if the labor market is healing, and that was the Achilles heel in the economy up until now, maybe we don't see the Fed cut rates as early and often as market participants would always like.
Yeah, and I think we're in a reasonable spot in terms of what the market is expecting for rate cuts, which I think is a good thing for investors just in terms of potential volatility if expectations are not met. If you're expecting two cuts and you only get one, well, you'd rather have two, but
Yeah.
is that a cataclysmic difference? If you get three, is that a huge boon? Not necessarily. I think that's a part of it. It's interesting. You mentioned the Fed thinking about the Achilles heel. I mean, I think it was even in discussion with you last week on this show. I still wonder when the Federal Reserve is going to refocus specifically on employment, and if they're getting reads like this, and this is the data that they are relying on. I don't think they are going to focus on it.
Yeah. And so, I mean, another piece of that puzzle is healthcare continues to be leading the league in jobs gained. And I don't know if those are considered good jobs, bad jobs, or if there's a concern that it's concentrated in one area, and maybe that's more related to an aging population than any kind of massive economic expansion. But did that trouble you at all?
It does. If you net out healthcare job creation going back to 2024, there's been no ads to the job market. No one's been hired. If you back that out, I think for us, in my worldview, as we think about employment specifically to productivity and that lens, thinking about GDP, for instance, there's an entire set of jobs that I would argue are probably not truly creating growth and expansion. And I don't say that to wish poorly on any people that work in these fields or to say that they're not important by any stretch. But healthcare is one of them, government's another, education service is another, where no disrespect to school teachers. My mom was a school teacher. But but is she going to work in creating something that can be sold and generate something that goes to GDP in real time? No. And so I think those sectors have had a huge lift, even going back to 2021, 2022, in terms of the size, those kind of institutional employers. But outside of those areas, we really have not seen much growth. And not only that, on the other end of the spectrum, we're seeing reasonable cuts being made by companies that are saying, hey, we can do more with less on the AI front or whatever it may be.
I think you should throw out an "I love you, mom" just to kind of round out the
Yeah,
picture.
yeah. I love you, Mom. Happy birthday on Monday coming up.
Okay. Happy
So
birthday,
let
Mrs.
me be the first to wish you happy birthday.
Exactly. Happy birthday, Mrs. Narwhal. And love you too, Mom. Then we get a CPI report today. That was good. I think in CPI down to 2.4 year over year. And I say good. I would assume you would agree with that. But again, the market didn't have much of a reaction to today's report.
Yeah, not a lot of movement. I think the area you saw the most movement is really on kind of the long bond. We saw those rates come in. People were a little concerned about the steepening of the yield curve. It's bent kind of the other way in the last couple hours as that data came in. Again, I think a lot of people think that the jobs report should not have been this strong. And I think people actually think the CPI report should be better in the sense that the largest component in there is home prices, housing costs, things associated with that. And the reality is that number is still bolstering a still low CPI print, but it's holding it up higher than I think most people think it should be. It's very hard to find real estate pricing data that suggests it's more expensive to buy a home today than it was a year ago. We're seeing rents. There's more of a geographic component on rental rates, but thematically, they're not up more than 2.4%, and yet those components of CPI are higher.
I've seen data for year over year price increases, but it's not greater than 2.4%.
Right.
It's more, a percent or so.
Yep.
And it's very focused on areas like where I am in the Northeast, where there's still tight inventory levels, areas where inventory has picked up, has not seen those price increases. They've seen price weakness. I saw a report that January was a very slow month for new home sales.
Exceptionally slow, even as mortgage rates came down.
It read like some kind of cataclysmic real estate report. And we got to get into residential real estate at some point in these calls, because I think there is something going on there. So it sounds like you'd like to see more jobs numbers in the next couple months to confirm what we saw.
Yep.
And that there's a little bit of a lag effect on shelter. And you feel like, inflation might be a bit better than what we're seeing, which kind of gets to your point that you probably would like the Fed to focus more on the jobs portion of the mandate because you think it's worse off than the data, and the inflation is probably better than the data.
Yeah, absolutely. Yeah, I completely agree.
Which would mean more rate cuts later, which, supposedly the market would appreciate. So I started kind of recapping how the market has done. Interestingly, the day that we got the good jobs data, small caps sold off quite a bit more than the rest of the market. And I think they love their rate cuts, those small cap stocks. So that explains that. But where are some of the winners and losers that you're seeing that you wanted to highlight for our multitude of listeners?
Yes. Great question. We look at the S&P 500 primarily for U.S. stocks. That's the benchmark that we use at Narwhal. And we're certainly seeing the broadening out theme that we talked about. I continue to tell everybody to, kind of take a pause. Let's see if this holds, because it has been a relatively short period. We're 5 or 6 weeks into the start of the year. But when you look at the S&P 500, it's down just a smidge year to date. If you equal weighted the components of the S&P 500, we're up 4.8%, which suggests that there are actually a lot of companies that are doing quite well to start the year. In reality, more than 60% of the S&P 500 is up, but the index is down. I think tonally, people have been pretty quick to jump on the simplified narrative that tech stocks are getting crushed. Some of them are, specifically AI-tied software stocks are getting crushed. But there are a number of tech companies, specifically those that are supplying hardware for memory chips for data centers, things that are supporting this AI trend, that are doing exceptionally well. SanDisk is the top performer in the S&P 500 so far this year. It's up over 160%. Western Digital is up 60%. There's a number of tech companies that are doing quite well. But then on the other end of the spectrum, you have those that some of which are even potentially cannibalizing their own business. At least that's the overreaction, in my opinion, from the market, like ServiceNow, in which, hey, AI's gotten too good. Are people going to need your licenses? If that's your business model and you've created tools that are too valuable, are there going to be fewer butts in seats needing a license because you've made businesses so much more efficient? And have you hurt yourself? So those are kind of the extreme things. Interestingly, I'm curious. There's a number of companies that are doing well for kind of the first time in a while. McDonald's is doing pretty well. Um, there's a couple of these names, and maybe next week we can touch on it because I haven't fleshed out enough research on it. But it kind of seems like this could be a year where kind of these core American brands kind of have a moment for a little while relative to the rest of, when we think of, traditional iconic brands, we don't necessarily think NVIDIA. But some of these companies that have been kind of under the radar seem to be operating at a pretty good level right now. And that's kind of interesting to see.
Yeah. So will you wear your Bucky's football jersey for that
Got
recording,
to.
or is
I
that
got
like
to.
emblematic of what we're talking about? All right. I love it. And yeah, I shared something in my Wednesday reading list where the companies that were able to benefit from AI in terms of utilizing it, not selling the services, and there's not a lot of them still
Yep.
reporting that, have been winners, coming out of earnings calls. And I know you're seeing or confirming the same thing. So just kind of going back to maybe what we talked about at one of our first conversations, you guys are an asset allocation shop. I mean, sorry, you guys are stock pickers. Heritage, we're an asset allocation shop. There is an opportunity for people to be investing away from a concentrated S&P 500 portfolio right now, whether it's picking different stocks or allocating to other areas. I do think that there's a lot going on that would let me, as an investor who's been kind of complacent on autopilot, owning large growth, owning just the S&P, to ask somebody to look at my portfolio and see what I can do to diversify away from it. And you and I represent two great but very different approaches to doing that. But people need to kind of update their portfolio if they've been complacent for years and years with what's been working, because it's not still working the best.
Yeah, it's a very different market dynamic than what we had a year ago, 2 years ago, 3 years ago. I completely agree with you
Well, I appreciate that.
for once.
For once, no, it's more than that. We're it's just college football that divides us.
Yeah.
Well, this might divide us a little bit.
I
Where
think
are
we're about
we?
to get divided
Yeah,
again.
we're about to fight. So, where are we in the economic cycle and the history of this? For those who haven't been in our tight circle of friendship, is I tend to think that we are late cycle in the economy, and I think you are of the opinion that we are early cycle. And what drives my viewpoint is the recovery has gone on for a very long time. I know that COVID kind of tweaked out the economic traditional cycle. Um, and I know that we had a couple quarters of negative GDP growth at the beginning of 22. I think if there was a recession, that was it. It wasn't labeled as such. So I think your viewpoint is like, yeah, that was the recession, and now we're in recovery mode, right?
Yep, that's my viewpoint. I think, let me preface my comments with this. I think everyone, regardless of where you think you are, where you think we are in the economic cycle, would be wise to take a pause and think, do we think economic cycles are going to continue the way they have historically? I'm of the mindset that what we think we know about cycles is outdated.
Hmm.
And the biggest reason for that is that from both a monetary and a fiscal perspective, not just here in the US, but globally, the level of intervention that has come following the financial crisis of '08 is staggering. And I think we have the powers that be that are much more likely to try to prevent a true down cycle, much more so than they were inclined to do so in the '90s, the '80s, the '70s, '60s, going back in history. And so I think that is a component that merits at least some pondering. I don't know that I'm right about it, but I think we're in a very different call it a financial political environment. I think there's more likelihood that people will intervene in ways that try to stem the bleeding. I'm not arguing that that's good or bad, but I think that's where we are. I would agree with the
And just
assessment.
real
Yeah.
quick, Andrew, there's interventions that are happening that would typically coincide with a shift in the economic cycle, but they're happening for different reasons. All the stimulus because of COVID,
Yep. Yep.
hiking rates because inflation for some reason just shot up, to 9%.
Yep.
And so it leaves somebody who kind of maps out traditional economic cycles confused, basically. So
Correct.
I see what you're saying. Yeah.
Yeah, I think it's gotten so much noisier.
Yeah.
It used to be when cause A will generate effect B. That's what happens. Well, now, hey, let's go ahead and do B, and I'm going to cause A. you know, for me, I'm of the belief that we had the pullback in 2022, as you alluded to. It was not officially deemed a recession. From my perspective, a recession is a prolonged period of economic contraction. We had that. Now, 2 years later, they revised Q2 2022 GDP and said it was positive 2 years later. But I just think of talking with business owners in that time, people that were making decisions based on economic data that was currently available. They felt like they were in a recession. They were seeing real pullbacks. So I view 2022 as the bottoming out, not just a blip on the radar, but a bit of a bottoming out. And so I would argue that we're early to mid cycle, depending on how you view it. If you're of the viewpoint of everything I laid out a moment ago, that there's going to be more intervention, I'm more inclined to say we're early than mid, just because I think the cycles are going to get elongated, regardless of where we are. When I think about where
So
we
Andrew,
are,
real
yeah,
quick, in supporting that, I mean, we also did see a bear market in 22, right?
yep,
And we're now in a rate cutting cycle, which you would see to kind of juice a recovery. So there's definitely a lot to what you're saying.
yeah, and I think if I were looking for signs of being later cycle, I'd be looking for persistent inflation. It's like, well, we actually had that in 2022, and as we just discussed a moment ago, I don't view that as a current problem. I don't see growth as moderating. We've talked about GDP now and forecast for economic growth on this over the last couple of weeks. I think we're seeing some acceleration and growth, and we're also seeing growth at higher levels than we've seen in recent history. I don't feel like we're in an environment of high interest rates. We're seeing those fall,
Yep.
to your point just a moment ago. The big unknown for me is unemployment. And that's where I kind of end up back there. That's the number one thing top of mind for me, because I don't know how to read this. I
Right.
don't really believe the report that came out this week. But if I am to believe it, then we're certainly not seeing unemployment rise. And even if we say, okay, well, it's back where it was in December, which was a little bit higher than it is right now, when you think back to '08, unemployment was above 5% in 2007. It was
Yeah.
at a higher level. And so I don't know what to make of it. I think, ironically, unemployment looks very, very strong and would probably be supportive of my argument that we're early cycle, but that's the one data point that I don't trust.
Yeah, I think that's what troubles you the most, right? Because one of the justifications they had in 22 for not calling it a recession was that the labor market was so
Yep.
strong. The labor market now looks better than what you don't think it's as good as they're portraying. So I could see that. I mean, to me, I struggle with the health of the consumer, and where their contribution to the economy is going to come from, and the fact that if 2022 wasn't a recession, it's been a long time, a lot longer than typical to still be early cycle. But what I am more kind of confident in isn't necessarily that call or that debate between us. It's the bigger picture theme that we've been talking about, that um, there is a market rotation that's going to happen if it is not already happening. And you could see that now, and that those cycles don't persist forever. Um, and so where we are in the economy, I do think it's become hard for folks like me, given what I've already talked about, COVID and the inflation hike, and to kind of really understand where we are traditionally because there is a lot of noise, as you point out. All right, well that's good. We can get out of here on that. I do want to say, like you have a colleague who's a Seahawks fan, challenged me on the podcast, your podcast, the Morning Market Briefing, to whether I'd be willing to appear. I messaged him through LinkedIn. I did not hear any acceptance of my acceptance. So I guess I would just, they clobbered us. It was not a good look for the Patriots. The benefit of playing against the Seahawks is you're really not going to run into a lot of Seahawks fans. This is not
Yes.
a high risk situation. It's like,
I know one.
yeah, it's like playing against the Oregon Ducks, right? It's like what's the trash talk that's going to come out of
Yeah.
losing to Seattle or losing to Oregon in college? But we both have a friend who represents the one, and I congratulate him. And I think there is just, if I had to lose to a team, yeah, losing to the Cardinals, to the Seahawks, stuff like that, that's safer than losing to the Steelers or
Yeah.
a real legitimate franchise.
A real team. A
Yeah,
real team.
a real franchise. So,
Well, Ben is running a marathon tomorrow.
oh,
He's somewhere out west. He's trying to qualify for Boston, actually. And something tells me he's just going to listen to your congratulatory message on loop while he goes through those 26.2 miles.
I mean, I did congratulate him.
Yeah. I mean, he did it.
He did it. All right. Well, have a great weekend, my friend. Thank you for joining me. And everyone, please be sure to check out the channel, like the video, subscribe to it. Check out Andrew at his team at the Morning Market Briefing at Narwhal. Thanks, buddy.
Thanks.